Hi, everyone. It's February 7th, 2023, and that means it's time to look at the previous month's Las Vegas real estate data released by the Las Vegas Realtors Association. So let's get into it. Okay, so here we are. This is the data for January of 2023, just released here in February. So let's take a look. Number of units sold. Number of units sold here in Southern Nevada, 1,325 in January. That's even less than in December, which had 1,534. A year ago, 2,561. So that is the change from December, 13.6% down. Change from a year ago, 48.3% down. Hooey, look at that. Let's look at the median price of units sold. We've got $425,000. That's the median price of those sold homes. And that's exactly the same as a month ago. And 1 year ago was at $435,000, down 2.3%. So we're down 2.3% than where we were a year ago on the median price of homes. Bit of a drawback there. Number of available units, inventory on the market. 5,450 homes do not have contracts written and are actively up for sale. And previous month, 6,211. 1 year ago, only 1,821, which is very much an anomaly, folks. That is an extremely low number of homes to be in inventory. And that is a increase of 200%. So we tripled the number that we had a year ago. That's where we are. And we're still not crazy out of line here with 5,450 available. Let me scroll up to this. Number of units available, that's what we're looking at. We're over here, 5,000, and you can see that we are not in any crazy, outrageous here areas. Down here, this is the really wacky area. This is 21 and 22, when inventory levels were very, very low. You can see that right there. And normal times right across the board here. It looks like we're right in normal times here. Let's see what else we want to see here. House about, if I can find it over here, give me 1 second. Number of new listings, there we go. And these are all single family residential. Doesn't include condos, townhomes, okay? High rise does not include those. Single family residential. Number of new listings, 2,477. And in December, we had 1,677. Year ago, 2,900. So we're up 48% from a month prior, and we're down 14.6% from the year ago. Now, a lot of this has to do with a lot of homes expired on January 1st this year, which had not sold prior to that. They may have been on the market for 6 months, something along those lines. And January 1st is a big day for expiring homes, the contracts to run out. And a couple previous years, that wasn't happening as much. So that has a lot to do with explaining that right there. And then we can look at months of effective inventory right here. We're at 4.1 months of inventory. That means it would take 4.1 months to run through at the number of units sold, to run through the number of available units, 5,450. 4.1 months. That's how much inventory we have. So time on the market, 38.5% of those sold homes, it happened, they were on the market 0 to 30 days. 38.5. only 0 to 30 days. 31 to 60 days, 23.8% of those. 61 to 90 days, 16.1. So you can see these numbers had recently been pushed down. If you go back a year ago, 71.3% of the homes sold in the first 0 to 30 days on market because they were going like hotcakes very quickly off the market. Now that's slowed down and we're almost at 50% of that right there. See that? 38.5 for 71.3. Dropping further than December. So that's still coming down somewhat there. Okay, that's our run through of this part right here. We've got some good stuff coming up here from Alto's Research. Okay, so here we are. Subscription to Alto's Research for this information. This is paid for information. And first thing we can look at is we are still at a slight seller's advantage. If you look down here, slight seller's advantage, we can see. And if we come further down here, let's look at properties with price decreases. Now, some of these things, if we were to look at inventory and stuff like that, Altos does a 7-day average down here, and they do a 90-day average. So this dotted line is the 7-day average, and the solid line is the 90-day average. And you can see that the 7-day average leads the way because it's a shorter time period. And then the 90-day is smoother and follows it on through. The longer time period results in a smoother line and one that lags behind the 7-day average. Makes sense if you think about it. So let's look at where we are with price decreases. And here we are. So the 7-day average, 48% of homes had a price decrease on their listing on the 7-day average. And you can see that that has come down precipitously from the high of 64% for the week ending November 11th of 2022, right there. So quite a steep decline on homes with price decreases. Now, what does that lead me to believe? I think some sellers are becoming more realistic in what they can expect on the homes, and that's starting to sink in with people. We're not going to see this right here. Gosh, isn't that something, huh? February of 22, where are we? February 22, way down here. Look at that. 7-day average was 19% down here. And March, we were at 16 1/3% price decreases. Surprised we had any the way they were going, huh? Okay, so that is something to see right there, isn't it? So we've kind of made the turn right here on this roller coaster ride. And we're still heading down south. Okay, so if we look at inventory here, we can see how the inventory for the Las Vegas market has changed recently. And if we come all the way up here, where are we? October 21st, the week ending October 21st, that looks like our high point. And we have been coming down again steadily since then for inventory levels, according to Alto's Research, right down to where we are there. So, and once again, if we look at that, we'll see that, well, this only goes back to February of 2020. So a little bit different there. And this, of course, is the crazy periods where things were just flying off the market when rates were 2.75, 3%. And people were just buying them up, and people didn't even want that. They had cash to pick up homes. So that right there, that's the inventory, just to get you an idea of what we're looking at right here. There's our peak, and we've come straight on down since then. So now let's look at the median list price here for the Vegas market. And we can see that we've had a steady increase here. And then we kind of turn the tables, and now we're smoothing out, actually. You can see we're smoothing out down here. So the incline has stopped, of course, and now the decline is also leveling off. And the little commentary down the bottom here from Altos tells us that the market seems to have paused around this plateau, and the market action index is a good leading indicator for the durability of this trend, which is a good segue to let's go see what that market action index looks like, shall we? Okay, so the market action index. Look at that. Boy, that's 7-day average. That really hops around, doesn't it? Goodness gracious, look at that in here. Wow. That was back in July and August of 21 into September of 21. Gosh. And then we're out here from August, gosh, all the way up until now. It's bouncing around, but the bounces have gotten smaller, haven't they? Just like it kind of did out here, didn't it? So we got some big bounces, and then we've we're plateauing, leveling off right in here. And the commentary down here on the market action index, excuse me, with this here, I apologize. While the market action index shows some strengthening in the last few weeks, prices have not seemed to move from their plateau. Should the upward trend in sales relative to inventory continue, expect prices to resume an upward climb in tandem with the market action index. Okay, so that says if sales continue to climb, the number of sales happening continue to climb relative to the inventory, that would force prices to resume an upward climb. Because if inventory does not increase at a pace that sales does, we're going to end up back where we were last spring, is what they're suggesting. And that would, of course, force prices to increase again. Maybe not, probably not so much at the great pace that happened in the past couple of years, but at a slower rate than that. But nonetheless, get on a upward trajectory. Okay, folks, so there we are with those sets of data from LVR and Altos Research. And mortgage rates, gosh, they're on a roller coaster of their own here. Last week, after the Fed announced their 25 basis point increase, rates decreased and got all the way down on Thursday to 5.99% with a 5 handle on there. So that was very, very good. But unfortunately, the next day, the unemployment numbers came out on Friday, and everyone was expecting a $200,000 or 200,000 increase in the employment numbers. And that came out to 500,000 instead, which is, well, very good for those people who have the jobs. But the bond market considered that bad news because the economy is not reacting the way that the Fed would like them to in order to tackle their inflation problems. So a strong economy, that's not what the Fed wants right now. They wanted lower employment numbers in order to cool down the economy. Instead, they got, instead of 200,000, they got 500,000 jobs gained, which in turn increased mortgage rates. I believe they were up to 6.15 on Friday, and then a little bit higher yesterday on Monday, and today they're up to 6.45%. So with the economy going strong, that's not good news for the mortgage rates. So everyone looking to be a home buyer, keep telling you that it's might be a good time to jump in there. Rates look like they're going to get higher. The Fed feels like they're going to be having to raise rates again here And let me see what Jerome Powell said today. Give me 1 second here. Okay, so here's what Jerome Powell said. Earlier today on February 7th, he addressed the Economic Club of Washington. And at the question and answer at the event, led off with the subject that's on everyone's mind. Fed Chair Jerome Powell said the disinflation process has begun, but that is in the goods sector. He added that in the non-housing sector, services is not really showing any disinflation yet. He said that the process of taming inflation is going to take quite a bit of time and is not going to be smooth. In the context of the January employment report, which registered 517,000 jobs added, he said the employment report shows you why this will be a process that takes a significant period of time. So they're making adjustments with the Fed funds rate. They're raising rates and taking a look at what that causes with the data that they get back. That's their feedback. And then they will make further adjustments down the line based off of that data. So the strong jobs number on Friday did indeed show that the economy is still running hot, and that is not good for inflation. And that is what they want to get down. So there you have it right there, folks. If you found anything in this little video here interesting, valuable, something that helped you, please give it a thumbs up, share it, subscribe. And if you need anything from me, if I can do anything for you, please don't hesitate to contact me. My contact information is on the screen, and I am here to help you. Love y'all. Have a good one. Bye-bye.